This chart compares Micron's top line for a single quarter, the third quarter of fiscal 2026, against its entire performance for 2023. In just 3 months, the company brought in $41.46 billion, easily eclipsing the $15.54 billion generated just 3 years prior. That sheer velocity of capital pushed Micron's stock up over 800% in the trailing year, driving the manufacturer comfortably past a $1 trillion market cap. This inflection point is the direct result of a physical bottleneck. The aggressive deployment of artificial intelligence models requires an enormous volume of high-performance servers. Right now, Micron is posting the kind of margins typically reserved for software monopolies. But history shows that this specific peak of extreme profitability is highly vulnerable to the brutal boom and bust cycles of commodity hardware. This schematic outlines the core architecture of an AI server. Processors need memory to function. Micron manufactures the standard DRAM and NAND storage that feed data into these systems. But the current bottleneck is a specialized, vertically stacked architecture called high bandwidth memory, or HBM, which sits directly next to the AI chip. Building the fabrication plants to produce these components takes years and tens of billions of dollars. That massive barrier to entry has consolidated over 90% of global DRAM production into a triopoly: Samsung, SK Hynix, and Micron. Within the highly specialized HBM sector, the market is even more concentrated. SK Hynix leads with a 62% share, while Micron has aggressively maneuvered to secure 21%, pushing Samsung into third at 17%. This tight control over heavily constrained supply is generating massive returns. Micron's data center revenue has now accelerated to an annualized run rate exceeding $100 billion. This chart tracks Micron's profitability over the last year. GAAP gross margins have spiked from 37.7% to 84.6%, while operating margins surged from 23.3% to 80.4%. Because semiconductor factory costs are mostly fixed, any exponential price increases driven by scarcity fall straight to the bottom line. But this pricing power is fragile. Just 2 years ago, a supply glut forced Micron to absorb a $5.83 billion net loss in fiscal 2023. To protect against the next crash, the company executed a defensive strategy. They locked in at least $100 billion in minimum revenue through strategic customer agreements, distributing that volume across roughly 16 massive clients. These contracts operate on strict take-or-pay terms with hard price floors. Customers are legally bound to absorb the financial risk of sudden demand drops, theoretically insulating Micron's cash flow when the broader market cools. The strength of those contracts is about to be tested. SK Hynix and Samsung are currently deploying a combined $575 billion in capital expenditures to build out new production facilities. This is the classic semiconductor commodity trap. Record profits trigger massive factory construction, and when those new lines eventually come online, the resulting supply floods the market and destroys pricing power. That incoming supply glut is compounded by external risks. Relying heavily on 16 mega customers creates intense concentration risk, while geopolitical export controls actively limit Micron's ability to sell into the Chinese market. Micron holds a cash-generating position right at the physical bottleneck of the current technology build-out. Yet they are still operating in an industry famous for catastrophic cyclical downturns. In the business of commodity hardware, an 84.6% gross margin is rarely a permanent plateau. Historically, it is the exact signal that triggers a margin-destroying supply avalanche.